Pioneering Portfolio Management, An Unconventional Approach to Institutional Investment, by David F. Swensen, author. Charles Ellis, Foreword. Summary: Pioneering Portfolio Management is a financial book that touches on subjects like institutional investments, asset classes, securities management, and how to adjust a portfolio based on risk, a diversified approach to investing, and overall asset allocation. Whether you're an individual investor just getting started in their journey, or somehow experienced in the field, or you're administering money at an institutional level, Pioneering Portfolio Management by David F. Swensen is a must-read if you want to upgrade your investment strategy, starting with the power of endowments, to the importance of asset allocation, and on to the long-term strategies an institution must approach if it wants to achieve financial success in the long run. This book covers it all. Most importantly, this summary will shed light on the investment philosophy of the 21st century, where the strategy of an organization is only as strong as the financial demands it meets. Here are my 3 favorite lessons from the book. Endowments are a powerful tool for the financial success of an institution. A successful investor knows the 3 core aspects of choosing securities to pour money into. A diversified investment portfolio is a recipe for long-term success. Now we'll explore each lesson one by one to get the main ideas behind them and extract the most useful information from the summary. Lesson 1. A successful long-term strategy of an institution usually includes endowments. Many organizations around the world, whether they're public institutions, universities or colleges, charities or trusts, or even NGOs, have endowments that ensure their long-term success. An endowment is a donation received by an institution from an individual or another institution, which has to be kept under the receiving organization's ownership for as long as they function. Although the receiving organization can benefit from an endowment through interest or other financial benefits that may arise, the endowment can't be sold, so as to ensure the perpetuating prosperity of the organization. For example, an alumnus donated 96 acres of land to Yale in 1996, which is considered an endowment. Reaping the benefits, such as interest, helps Yale keep their financial status in great parameters. Although they are crucial for long-term success, some people may not rush when it comes to accepting endowments. The uncomfortable aspect of receiving them as an institution is that the donor may require the organization to carry out research in different fields upon request, use the funds in a certain way, or take certain decisions that may not appeal to the executives of the enterprise. For this reason, not all donations go through as endowments. Lesson 2. When investing, you must take into consideration 3 core aspects. A wise investor knows that in order to get on top of the game, they must invest in a smart way. That means considering the risk factor, the time frame, the securities they bet on, and many other crucial aspects. In fact, an investment analysis starts with 3 core aspects: asset allocation, market timing, security selection. Asset allocation implies picking the classes of assets that you'll be investing in. This factor is the most important when it comes to forecasting returns. The second aspect, which is market timing, refers to seizing opportunities in the market based on current events. In the long strategy of an investor, there are moments to buy, moments to hold, and moments to sell. Market timing is all about that, and it can help investors pick security on discounts or avoid buying overpriced ones. Lastly, there's the security selection. Here an investor decides if they're going to be active or passive in their approach. A passive investor mimics the market and does not actively pick or trade their securities in the short-term or long-term strategy, because the market returns a higher average than most investors can on their own. Therefore, a passive strategy is more successful in highly efficient markets, bonds, stocks. In contrast, active investors do their own research and pick their securities according to certain parameters. They do this in the hope to gain a higher than average return on investments. However, the active approach is advised for real estate markets, private equity, venture capital, or any investment that must usually be picked individually. Lesson 3. Diversifying your portfolio is one of the most powerful principles of investing. Way too often, investors jump in too early or too late in the market, or they invest only in highly traded, increasingly popular securities because their peers do too. Unfortunately, this approach to investing has left many people and institutions with their empty pockets hanging. Instead, the key to success is a long-term vision and a diversified portfolio. As mentioned before, one of the core aspects of investing is asset allocation. Among the different types of securities, an investor or an institution must choose different asset classes and allocate funds accordingly. A well-balanced portfolio usually includes stocks, bonds, and real estate, all from domestic, foreign, and private markets. Due to the fact that markets fluctuate and drop in value at times, it's best not to have all your eggs in one basket. Allocating funds to various asset classes will ensure that your net worth fluctuates as little as possible while increasing at a steady pace. A good rule of thumb between investors is not to allocate below 5 to 10% to a single class of assets. Why? Because it won't affect your overall performance. Don't allocate above 25 to 30% either. Doing so can hold too much of your net value blocked in case of a crash.